Alright, so today I was finally able to sell some call options on Activision at 45 strike price. Sold it for $1. Today it actually closed. I think it went all the way up to $1.17. Yeah, the high for the day was $1.16. So I missed out on 16 cents times 200 shares. But hey, it was trading at 70 cents. But it was also trading at 70 cents, so I guess $1 can't complain. So basically I collected $1 on a 44.7 average cost for this stock. So that's about 2.2% in 1 month. So not the regular 3% that I'm going for, but still 2.2%. What's great is that this is a stock that I bought at an average price of 44.7, collected $1.09 the first month. The stock went all the way down to 39 and 40, and now is climbing back up. And I was able to collect another $1 for the following month. So if I had just bought the stock and did nothing, it'd be down 2% on a stock. But instead, I collected call options or call premiums the first month and the second month. So I collected $1.90 the first month and I collected $1 the second month. So obviously the call premiums vary depending on the price of the stock and the strike price that I choose. But the reason why I really like this strategy of writing covered calls is when the stock isn't moving or going the wrong direction, you can still benefit from your position. So in this case, I still hold the stock, but I was able to collect $1.90 the first month and $1 the second month. So I collected $2.90, and it's as if my true cost is 44.7 minus the $2.90 that I collect. So anyways, I chose a 45 strike price, meaning that come April 18, if the stock is trading above 45, I accept to sell my shares at 45. I'm okay with that because my goal is to make 3% per month. I made that the first month easily, and the second month I made 2.2. If my shares get called away at 45, I'm fine with that. Actually, if my shares get called away at 45, I'm making an extra 30 cents. 45 minus 44.7. So it's actually 1.3 divided by 44.7. So I'd be making close to 3% the second month as well if the stock does end up above 45 come expiry date. And also depending on how far it is from my strike price, I could probably buy back and sell another call option the following month. For example, Bristol Myers here, my strike price is 50, but it's trading right now at 50.97. So if I wanted to buy back the call option so that I keep my shares, I'll buy back at $1.14. And if I sell the following month at a 50 strike price as well, I could probably go collect $2.88. So that's $1.74 that I can go collect for the following month on a $50 price. That's 3.4% in a month as well. So that's really what's great about this strategy of covered calls. Now, I do regret last week when the market was down, a bunch of my positions were trading below the strike price that I sold at, and I could have bought back a bunch of options very cheaply, but I didn't because I didn't want to be too much involved. I don't want the strategy to be too time consuming. Ideally I want to look at this once a month. So if I keep buying in the middle of the month to sell a little bit later, it requires me to pay more attention and to be more involved, which is not something I want to do. I want this to be passive as much as possible. At the same time, I could have bought a bunch of options back, but I don't know which direction the stock would go after I buy them back. They might go up. The stock might go up. That would be great because I got to buy the options cheaply, but they might continue to go down. So that would mean I bought the options for nothing because they were going to expire worthless anyways. So that's why I don't want to be too proactive because I don't want to start guessing the direction of every week. I just want to guess the general direction of a stock in a 1 month period. So Boeing, you must have heard about Boeing and the crash and how the stock took a major hit. So today it's up a little bit, but the past 2 days it's been down pretty sharply. And this would be a stock I'm very comfortable buying because I know it's a company that's never going to disappear. So it got some bad news temporarily, but it's going to recover. The stock price is going to recover very fast. Actually, a great way to make a quick $400 is actually to buy 100 shares of this stock, which of course is going to require a lot of money. It's going to require $37,000, and then you could sell the call option expiring March 15 at the strike price of $380 and collect $425. Now there's a big chance that it stays below $380 come March 15, so you'll keep the shares, but you would have collected $425 easily. And then the following month you could sell another call option. Look at this, at the $380 strike price, it's trading at $16.75, so you could collect $1,675. So that's a return of 4.4%. Now there's a bunch of stocks here that I might buy back the option because the stock is trading very close to the strike price. So it might be interesting to buy back the option and then sell the following month's call option. But I'm going to leave that to Friday, and I'll try to make a video live showing how to buy back the options and sell them right away with Questrade. So Immunogen was a stock that I bought just for the call premiums. I bought it at 5.7, sold call options at 1.6 at a $5 strike price, assuming that the stock would not drop from 5.7 to 5 in a month, but instead it dropped 50%. So it dropped from 5.7 to 2.72. So this was a bad trade, buying a pharmaceutical company that I don't know anything about just because it had high call premiums. So now I'm paying the price. I'm down $1,100 on it, but it's not the end of the world because I collected $1.60 from the stock. So my cost is about 4.11 because I bought at 5.7, collected 1.6. So my cost is about 4.11. Right now it's trading at 2.72. But what I could do the following month is sell more call options. So if I go for April 18, knowing that my true cost is 4.11, so I don't want to sell under that or else I lose money. So if I go for the $5 strike price, which I'm comfortable selling at, of course, because my cost is 4.11, there's nothing no one wants to buy. If I go for the $4 strike price, I could probably sell it for 5 cents or 10 cents. Now, if I do that, I would have to hope that the stock stays below 4 come expiry date. Or even if it does go past 4, well, I will lose probably 5 cents per share. So probably a good way to recover my money and not lose as much as I'm losing right now. Or what I could do is go 1 month, an extra month out. I could go for June 21st expiry date instead of April. So that would be 3 months out, and then I can go for the $5 strike price because there's people buying, and I could sell it for 10 cents. So I could go ahead and collect 10 cents on this stock that's 10 cents per share. So that's about, on a cost of 4.11, that's about 2.4% in 3 months time. So that's not so great, but given the situation, it's not bad. I'll keep reducing my cost basis by selling call options until the stock recovers. So I've got two options: either sell at a $4 strike price and hope that it doesn't reach 4, or sell at 5 and then just wait a little bit longer. This is my fault because I went for a stock that I knew nothing about and I just went for it because of the high call premiums. Although I did that probably 4 times or 5 times, 2 out of the 5 times backfired. So I was aware of the consequences, and I guess I'm paying the price right now. So yeah, just want to share with you that I was able to sell some Activision call options again this month, and that I'm really enjoying the process. Hopefully it continues to go well. So if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250. And yes, it is tax season, so if you're looking for an accountant to do your taxes, don't hesitate to message me. Link will be provided below. Thanks for watching.